Let's dive into a really fascinating puzzle at the very heart of the U.S. economy. It's all about the Federal Reserve and its so-called surprises. See, for decades, these supposedly unpredictable shocks have been, well, kind of predictable. So how is that even possible? Let's get into it.
It really does sound like a riddle, doesn't it? Can a surprise actually be a surprise if you can see it coming? This is the exact question that has had economists scratching their heads for years. And today, we're going to unpack a brand new explanation that might just solve it.
Okay, first things first, let's make sure we're on the same page. A monetary policy surprise is really just the difference between what Wall Street bets the Fed is going to do with interest rates and what the Fed actually announces after one of its big meetings. Simple as that.
Now, in a perfect world, in a perfectly efficient market, these surprises should be totally random. They're supposed to be these pure policy moves that nobody, and I mean nobody, could have possibly seen coming. At least, that's what the textbooks tell us.
But here is where it gets interesting. For more than 30 years, economists have known that's not the whole story. These so-called surprises can often be predicted, at least partially, using information that's already out there for everyone to see before the Fed says a word. It's known as the predictability puzzle, and frankly, it's a huge headache for economic models.
So what's the explanation? Well, for a long time, there have been two main theories duking it out. But as we're about to see, they both have some pretty serious holes in them.
The first idea is basically that the Fed just knows more than we do. They have access to some secret, top-tier economic data. The problem with that? Well, that's a big one. Researchers have shown again and again that the information that predicts these surprises is already baked into public data and financial market prices. So it's not really private info at all.
All right, on to theory number 2. This one suggests that markets are just slow learners. The idea is that traders consistently underestimate how strongly the Fed is going to react to economic news. But this has a giant logical flaw. I mean, come on. If this was a consistent pattern, why in the world haven't the supposedly brilliant minds on Wall Street, with literally trillions of dollars on the line, figured it out after 3 decades? It just doesn't add up.
So, with our old theories on shaky ground, we need a new clue. And that clue, it turns out, comes straight from the top, from the Federal Reserve Chair himself. And this is where the story really takes a sharp turn.
Just listen to this quote from Fed Chair Jerome Powell. He says we do look at financial conditions very broadly, but we don't target them. He says they're an important piece of information. Pay attention to that subtle distinction there. Financial conditions are critical information, but they're not an official goal. That little nuance, well, it turns out it's the key that unlocks this whole mystery.
So a new research paper argues this quote actually reveals the Fed's real strategy. Here's the core idea. The Fed isn't just reacting to a single piece of data, like a jobs report. No, it's reacting to how that data changes the entire landscape of financial conditions. How easy or hard it is to get money, which is reflected in stuff like stock prices, credit spreads, and market volatility.
This new theory is all built around what's being called a wait-and-see strategy. So how exactly does waiting around create a surprise you can predict? Well, it all comes down to a crucial delay in the whole process.
Okay, here's how it works. Picture this. A big economic number comes out. Markets see it, and they immediately think, okay, the Fed's going to do this. But the Fed, they don't jump. They wait. They sit back and watch to see how that news actually gets digested by the entire financial system. It's this delay, this gap between the market's instant reaction and the Fed's more patient, observant one that creates the predictable surprise.
Now, a good theory needs some solid evidence to back it up. And this paper lays it out like a detective cracking a case in 3 really clear steps.
So first, the research confirms that all the info used to predict these surprises is already public. That officially kills the private info theory, dead and buried. Second, it finds something really weird. Economic data that comes out right before a meeting, like within 2 weeks, actually has this kind of backward effect on surprises, which is exactly what you'd expect to see from a wait-and-see strategy. And third, and this is the real kicker, it shows that financial conditions all by themselves can predict surprises just as well as all the other complex models put together.
And this chart, wow, it just illustrates the point perfectly. Look at the bar on the left. The old models, using all the standard economic predictors, could explain about 12% of a Fed surprise. Not bad. But now, look at the bar right next to it. Once you add financial conditions into the mix, the predictive power of those old factors just evaporates. It drops to less than 1%. It's incredible. Financial conditions aren't just one piece of the puzzle. They're practically the whole puzzle itself.
This new approach also just makes our economic models cleaner. See, in these charts, the yellow and blue lines show how the older models predicted the economy would react to a Fed rate hike. And you can see they often have some pretty strange, counterintuitive results. Economists call them puzzles. But that red line, that's the new model, adjusted for financial conditions. It shows a much more logical, realistic response. So the theory doesn't just solve the puzzle, it makes our other tools work better too.
Okay, so we've just cracked a 30-year-old economic mystery. That's pretty cool. But why does this actually matter in the real world? What's the takeaway?
Well, there are a few huge takeaways here. For one, we now have a much clearer, more realistic picture of how the Fed actually operates. It's not just some machine crunching data, it's an active observer watching the markets. Second, this kind of flips our understanding of the whole relationship. Markets aren't just reacting to the Fed, they are a primary source of information for the Fed. Third, this gives economists way better tools to study the real impact of policy. And finally, all of this raises a really big question about the Fed's whole communication strategy.
And that brings us to our final question. The research paper itself points out that we can't really rule out that this is all part of an intentional communication strategy. So is the Fed's true method just poorly explained? Or is this ambiguity, this predictable surprise, actually a feature, not a bug, of its policy toolkit? Now that is something to think about.